to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
What's up, Ian?
What's up, dude?
Not too much. Just want to make sure I got the right mic tuning in, and I get this mic and not this mic, even though it's decent. What's going on? Friday, January 15th, 2021. Glad to be back with you with another Real Estate Reserve podcast. Definitely a fun topic, or a topic that I believe is interesting. You know, how to write different real estate investments. That is what we are going to blab about for some time today. Feel free, as we're talking, to ask any questions. It's an interesting topic in general because I underwrite deals on a regular basis. One might say loans, but really just deals in general. So it doesn't matter, what side of real estate investing that you're in. You got to have an underwriting hat on at all times. If you're flipping houses, if you're wholesaling properties, if you're buying apartment buildings, if maybe you're lending money to somebody, no matter buying rental properties, you got to have an underwriting hat on. And I know that's difficult for a lot of people. And the reason why is, as a real estate investor, you really wear two hats. You wear your kind of like personality front end marketing cap, right? The marketing cap is, hey, I'm trying to find deals. I'm going to talk to sellers. I'm going to do this. I'm going to do whatever I can in order to find an opportunity. And then on the back end, you got to wear your underwriting hat to make sure it's a good deal and a good opportunity. And that's challenging for some people because they get a little bit too emotional, and all they do is they see the dollar signs of, oh, I can make $50,000, or I can make $20,000, or I can do this, or I can do that, and the emotions kick in. So we're going to go through some different strategies today. We're going to go through that. I'm going to bring this up on the screen real quick. If you have not heard, we're doing our REI Madness free virtual event starting Monday, January 20th. Is that the 25th? Is that right? Yeah, starting January 25th. It's a free event. You can go to reimadness.com. We'll be streaming everything there. We brought that. It's through kind of this podcast. It's through the Real Estate Investing Meetup group. And we've got 21 local expert speakers divided into 7 teams to discuss and, for the most part, kind of battle to provide the most value that they can to you as a real estate investor. So we're going to circle back soon. It's an absolute free event. If you care to donate to the Metro Burn Foundation, if we provided you any value, feel free. You can do that. A lot of our sponsors are donating as well. So that's going to be a good fun event. That's coming in here, coming up here shortly. So cool. Well, let's get into. You got anything else to add, Ian, or should we get into this topic?
No, that's it, man, because I don't want to get off topic on REI Madness since we underwrote that whole project. It took us a while, but I think everything in life kind of takes underwriting, right? Like we had a calculated risk to do the REI Madness. What would it benefit? Who could we aggregate? Like, how does that event look? And I don't think people take enough time, especially now in this market, on underwriting deals. And it's not just fixing and flipping or just a rental property or any asset class you get into. You got to take the time to look and see, how does your capital look? What marketplace factors are out there? Right before we got on here, me and Jason were talking. There's talks of an eviction moratorium potentially into September of next year. How are you going to change your underwriting models for that? How do you change your underwriting models for lower debt rates? How do you change your underwriting model for higher prices? Or do you stay the same? It's been a topic that's consumed me and Jason recently a lot, and we thought we could bring a ton of value to everybody. So Jay, why don't we jump right into it? Do you want to go by asset class, or you just want to go over on underwriting as a whole?
Let's go by different asset class. I think that's important. Obviously, one thing to always take in consideration is risk versus reward, but also what's your end game plan on some of these deals. Like, when you underwrite or you invest, you almost have to work backwards. You got to figure out what the game plan is, what you want out of it, and then work your way back. So let's talk about flipping, right? Let's kind of dig into that a little bit. Now, obviously, the traditional way to underwrite, we'll talk about flipping, and then we'll talk about some wholesaling, we'll talk about rentals. I'm happy to spit out some knowledge related to underwriting, private lending if someone wants to kind of lend money to, increments of money to people. We talked about that. We'll talk about some apartment investing and some commercial as well. So, the traditional way that you would typically underwrite a flip the max you could purchase it would be 65% based off of your after repair value minus construction costs, right? So let's say the after repair value that you could flip the house for was $200,000, and it needed $30,000 in work, right? So the most you could pay for that property is $100,000. And how I derive from that number is you buy it for 100, you put 30 into it, right? So that's 130 combined, and that's 65% of the after repair value, right? You have $70,000 in gross equity, right? Now we all know that $70,000 in gross equity, net equity ends up being about half of that when you take in purchase costs and closing costs and potential financing fees and holding fees and selling costs, right, with realtor fees and transfer tax when you sell and other additional things. But that traditionally was the model. Over the years, obviously, people would get more aggressive, and they would go from 65% to maybe 70% of the after repair value minus construction costs, and maybe even slightly higher. But there's a point where the numbers just aren't going to work, right? As soon as you start getting close to that 75%, the numbers just aren't going to work. You can go through them any way you want. We have a few deal analyzers on our Hard Money Bankers website. You can go through them any way you want, and let's kind of go through a situation real quick on this. And we don't have any visuals to show this, but if you can kind of follow along, and if you're following along, if you want to write it down, that's fine too. And most of these numbers I know off the top of my head because I analyze deals that we lend on to other real estate investors every day. So most of this stuff is pretty simple. So let's use that formula, right? $200,000 after repair value. Right? You're buying it at, actually, you know what, Ian? Do you want to open up a notepad and share the screen and we can do that? Or should we just start?
Yeah, I'm doing it on Excel, so let's go.
Okay, cool. Let's go. This is good. Okay, so an after repair value is 200. Let's just say projected purchase price is 100, and then the renovations are 30. And again, we're going to do this for all different type of asset classes, but follow along with this setup. Okay. So you're going to have purchase costs very darn near close to 5%. Doesn't matter if you're paying cash for it or if you're financing it. Either way, your closing costs will be 5%. Where that number comes up with, and let's just use 5% of the purchase price. But you're going to have transfer and recordation tax, right? That's like a 1.5% give or take. You're going to have property taxes that are typically going to be due or prepaid or whatever that case is, depending on what time of year you purchase the property in. And we know property taxes are typically like 1% of assessed value or higher. Obviously, it's higher in Baltimore City, it's higher in Prince George's County, but it just depends. So that's there. You have flat title fees, you have property insurance, you have title insurance, title work, and just miscellaneous attorney fees and things like that. It's going to end up being 5%. Any way you look at it. If you buy lower price point properties, it's going to be higher than 5%. If you buy higher price point properties, just because there's a lot of flat fees that go into that, it's going to be lower. Okay, you're going to have some sort of holding costs. Holding costs end up being like 2%, right? You have BG&E bills, you have water bills, you have sewer bills, you have additional kind of holding expenses just for owning that property. Even if sometimes ongoing insurance expenses, things like that. So let's call it another $2,000, give or take. You're gonna have financing costs possibly, in the situation, right? So on the financing costs on the low end, let's say you have a bank and they charge you 5% in a point. And we can do some quick math on this, but what holding time you want to go off this, Ian? 6 months?
six months. Yes.
Okay, let's do 6 months. So let's say you have 5% in a point from a bank on this particular situation, right? So let's say they give you the whole 130. They charge you 5% plus a point. So that'll come out to about $5,000, give or take. With additional stuff. And that's financing costs plus points and other stuff. So then now let's say now you have holding costs, selling costs. So when you're selling a property, typically you need a realtor. A realtor is going to charge you anywhere between 4 and 6%, give or take. Let's just say it's 5%. So that's going to be $10,000 off the 200 exit, right? So I don't know if you want to put that in there. Maybe do a realtor.
We always did 9%, but either way, that's fine.
Yeah, I mean, I typically do 6.5 to 7%, and then I would do seller subsidy because all seller, most deals right now they have seller subsidy. So why don't you do seller cost 7%, and then let's do seller subsidy 2%. Let's go through that real quick, and let's see what those numbers shake out to.
This is totally ad-libbed. We had no premise that we were doing this.
All right. Okay. So is it safe to say, Ian, before you calculate all these numbers, that this is a best scenario? Right?
Yeah.
Like these are non-negotiable. These are all factual numbers. They're not going to change. They're not going to get any better. So calculate that out. Let's see what the profit is on that particular deal.
So that would equal this. What would equal this minus this
minus everything.
For those of you who don't know how to use Excel, there's a life lesson right there.
I was gonna say it was gonna be about 42 grand. Okay, so you have $40,000. Great flip, right? Great flip. Who doesn't want to make $40,000 if you're renovating, if your ARV is 200 and you buy it at the right numbers? That's great. So that's best case scenario, and that's assuming that you bought it at the 100. So now, Ian, real quick, change it. What's 75%? Change it to 75% LTV. So let's say 200,000 times 75%. So 120. Well, there's the answer. It's $20,000 if they buy it up to 75. So listen, when it's all said and done, if you buy it the right way, but that's why it's so important that you've got to buy it at these numbers: 65 cents on the dollar, 70 cents on the dollar, minus construction costs, right? You got it, because if not, it just doesn't work. And I know everyone's like, well, this is where people run into problems. This is a mistake I see all the time when people are emotional. Investors are emotional. Well, the neighbor just sold, or there's a nice house that just sold for 210. I think I can get 215, even though it's probably only worth 200, right? So you can squeeze 15,000 there. Oh well, my contractor said it was 30,000. I'll beat him up. Maybe I can get it down to 25, right? That's not going to happen. Typically, it's going to sell lower than you might think, and your renovations are always going to be higher than you think. That's just the nature of it. Like that's just what it is.
Yeah. And this is best case scenario. We did a lot of flips in 2014, 2015, part of 2016. We did a lot. We saw a lot of things. We saw a lot of problems. We saw a lot of unforeseen. You're not going to find a house at this price point and renovate it for $30,000. They rarely happen. Those lipstick pigs are not out there, and usually the lipstick pigs cost way more money than you expect. You're not going to go in, find something that just needs a kitchen, a bath, and switch the flooring out and some paint. Just not going to happen. Number two, we have appreciating material costs, supply chain issues. Hold times are going to be longer. Sure, houses are selling really quick, but trying to get supplies is an absolute nightmare. I mean, you're talking about a few month delays. We just ordered 300 something windows for an apartment project. Normally we would get them in 3 weeks. It's taking us 16 weeks to get. So that's another thing that you want to adjust for underwriting. We've talked about it a lot here before. 2014 to 2016, you could screw up, right? But the market was going on an upward trend. Well, guess what? If I screwed up, all I had to do was wait 3 more months, and it was worth another $10,000. And that's the difference of losing 20 grand or breaking dead even, right? So that was a huge help to us when we were getting in. now more than ever, we're at the top potentially. We're at the top of we're at a plateau right now. Let's look at it that way, right? We don't know if we're going up. We don't know if we're going down. A lot of speculative guys are saying down. A lot of guys like me are like, I don't know where it's going to end. It just keeps going up because you got appreciating costs. Like, how does it stop, right? So no matter how you look at it, we're on a plateau and no one knows what to do. And if it goes up, sure, you screwed up, but at least you diversified your risk. But if it goes down, you really saved yourself. And I think now more than ever, and Jason as a lender probably protects himself all the time, is that it could take you upwards of 6 months to try to find a deal right now, the right deal to deploy capital on. And I think this proves it right here. Just by a swing in 10%, yeah, it's only it's not that much money in the grand scheme of things when you look at this. But imagine if one thing goes wrong, that's a $19,000 mistake, right? Like,
yeah, your construction costs are not going to be $30,000, and in order to sell for top dollar, it's got to be a full renovation. I mean, a lot of building materials have 4x'd since COVID's hit. So again, you have the benefit of, hey, the market's good and stuff typically sells for higher than expected, but at the same time, the expenses are going to be higher and things like that. And, as soon as the market softens, you got to be very, very careful because things aren't going to continue to increase. And I've seen it firsthand that they've stopped. So, all right, so that's flipping. Let's talk a little bit about wholesaling. It's a similar setup, but kind of different. And the reason why is when you're wholesaling, I don't know if we need numbers on this one, but when you're wholesaling in general, let me just write wholesaling, underwriting a wholesale deal. Oops, I spelled deal wrong. When you're wholesaling in general, you're wholesaling to another investor, right? Either that they're going to fix and flip themselves or buy as a rental property, rarely live in it type of situation. So a few things. You kind of have to follow the same model, right? Because let's say you follow the model that we just had. Can we put this on the screen or no? Oh, no. If you follow the model we just talked about, well, let's say there's $30,000 in equity that the investor can make. Well, that means you got to get your fee in there somehow, right? So either, if an investor wants to make that, you either have to get the property, instead of buying it at 100, you got to buy it at 90 or 95 in order to make a $5,000 or $10,000 difference, arbitrage on it. Or you got to find an investor who's willing to take a smaller spread or smaller margin. So you still need to understand the exact same skill set of how to underwrite a deal. You just have to buy it that much better in order to leave enough room for the investor. But I will tell you that in general, that's one way to look at it. But the other way to look at it as a wholesale deal is understanding what investors are willing to pay, right? And sometimes that's difficult unless you have experience. I mean, we know some big wholesalers have been around for a long time, and they know what investors are willing to pay in every neighborhood. So they know how much they have to get the property, how much they got to pay for the property.
Yeah, that's an interesting way. I think when everyone gets started, they should take the time to underwrite the deals number for number, dollar for dollar, understand where things are coming from. But as you get more experience, you could just jump on MLS or you can jump on SStat here locally in Maryland and be able to take shortcuts and figure out what other people are paying and say, well, people are willing to pay it, they'll buy it, right? And I guess that's the adage of supply and demand per se, right? Like my neighbor's paying this, so I got to pay that type deal. So I think that's a good way to look at it. Wholesaling in general, now more than ever, is probably a little tough just because, in a depreciating market, people don't know how to sell their houses and there's a ton of inventory. A realtor doesn't give you a competitive advantage. Nothing's selling at market. Right now, I could call a real estate agent, put my house on the market and sell it in 3 days for top dollar, right? So as a wholesaler, I think you need to find a way to pitch yourself and bring the most benefit to your client or to you, the person that you're purchasing the house from, to ultimately sell the contract. You need to come up with your pitch for that, right? And when you're underwriting the deals, you need to be overly cautious and you need to be able to show the person that you're trying to buy the house from why you need to be overly cautious in your numbers because of appreciating material costs, because of long hold times, because you can't find renters. It's taking longer and longer to find tenants. It's harder and harder to evict tenants, right? Whatever you're doing with that property, whatever the plan is. So with that being said, definitely, take a look, jump in, underwrite the numbers as best as you can. Especially here in Maryland, you have access to SStat, so you can see what other properties are selling for, and you have a major competitive advantage. So,
yeah, exactly. But I feel like so many wholesalers, they believe, oh, I'll just go buy a property and then I'll just go contract a property and I'll go sell it to somebody else. Well, you got to make sure there's enough room for that end buyer in that. Do you want to talk about rentals, about how to underwrite rentals?
Yeah, we could do a screen share. I'll dig through while I'm talking, but
okay.
I think, and I don't know where you're going to go with rentals, but I think the first thing you need to understand the big difference between rental properties and flipping a house. And as we get into rental properties, it's going to lead us into storage and apartment buildings and industrial warehouses and everything else. Then it all starts to become a metric of your dollar. And it might not be as clear in flipping houses because you can get complete leverage on it. It might be a little bit harder to see because you see dollars in, dollars out on large scale. So you're like, it's more about the money. It's not like really a return on capital per se. But as you get into rental properties, you got to start to look at more of like your stock portfolio, and you're going to have diversification. You're going to have different asset classes, and that's how you need to look at it. So when you're underwriting it, remember the amount of capital that you have in the deal, whether you refinance it completely or you have a little bit of dollars. A few underwriting points that I'm going to give to you right now about rental properties. When you're underwriting and add this into your model is number one, it's getting a little bit harder to find tenants. There's a little more cautious COVID fatigue, whatever you want to call it, people going out and looking for properties. It's a pain in the butt to go put your mask on, go ride around, go do your thing, right? Like nobody wants to do that right now. Number two, you have debt rates that are super low. We all get, most of us are getting 5-year or 10-year rate adjustments. Where's the debt going to be 5 or 10 years from now? If we could all predict it, I'll just steal Jim Chivers' line. We'd be on the beach drinking Mai Tais, right? Like if we knew where the market would be 10 years from now. So you need to understand that debt is super, super cheap now, and the likelihood of it staying this low for more than 5 years is probably not going to happen because at some point the economy is going to get turned back on. Another thing, if you're renovating the house to rent it out, it's taking longer for materials. It's taking longer for inspections. It's taking longer for plan approvals. Those are all things that you need to calculate in your hold period or your stabilization period to getting the property back in order. And there's something else I was going to tell you. Oh, it's getting very, very hard to evict tenants that are not paying, not because of COVID issues, just in general because the courts are closed down. Right, wrong, or indifferent, that's what's going on. There's tenant assistance money that's not being deployed. There is tenant holdovers that you're able to get your tenants out with. However, there's starting to become a press on the tenant holdovers. So with that being said, you just need to understand all these things going into buying your first property or buying another property to add to your portfolio. Can you endure these problems to get to the end goal? And I know a lot of people have trouble seeing that long term, and I do. Because I guess, as much as I am a visionary, I get stuck on some small things, right? But these are all things that you need to underwrite in your model and take longer, a little deeper look than you normally would at these types of things.
Sure. Did you want to do a breakdown or no?
Well, I was yapping, so you yap for a little bit. And I'm going to go dig up my I'm going to go dig up our underwriting portfolio pro forma. So, but no, seriously, like when it comes to now you got me going again. When it comes to underwriting rental properties or anything where you're leasing out anything, whether it's a single family rental, a multifamily rental, a self-storage building, an industrial building, whatever it is, these are all things that you need to look at and that you're combating. And it comes down to what your I can't do two things at once. What the return on your dollar amount is. And I know
don't worry about the breakdown because we can verbally go through it, which is fine anyways. I mean, in general, the two big things, and we can talk about apartments in a little bit, but we're just talking about single, 1 to 4 family, smaller scale rental properties. But there's two things to look at. Make sure you have it at a good number, a good buy price on the front end, right? So you have equity built in. I know in essence, like you could potentially pay like 120% of the value of a rental property because it has really, really good cash flow, and it doesn't technically matter if you're not going to trade it in the near future and buy and sell it. And I know people that pay an absolute premium for stuff because they're really good cash flow properties. So the equity, because they're not selling it, doesn't really matter. But I do think that, it's important to have some sort of built-in equity. Now, either some sort of value add where you can improve equity, or just some kind of inherent equity. So like there's the equity side of it, and then there's the cash flow side of it. The cash flow side, depending on who you talk to, and during the REI Madness big event, there's a lot of rental property owners, so they'll be able to tell you their insight. In my opinion, it's not really as much as a percentage basis as what your time's worth. So like in general, a lot of people are like, I want to make $500 a month net per rental property. Like that's the goal. That's the setup. So for instance, when they run it through their model, their underwriting model, they look at the deal and it says, okay, cool, I'm buying it for $100,000. It needs like $10,000 worth of work. I'm putting this amount of money down. I'm financing this amount, whatever the case is. I can get $1,200 worth a month in rent, and my total expenses, including debt service, is $700, let's say, and I get $500 positive cash flow. A lot of people don't take in consideration, don't add in their capital expenditures. They might underestimate their maintenance costs, but whatever. That's just the way that they look at it, right? They don't try to overcomplicate it. They want to make about $500 net. Most rental property owners that I know, I'm not saying this is always the case. I know a lot of people buy turnkey stuff, but a lot of them, they do some sort of value add situation. So a lot of these deals don't work as flips, but they might work as rentals, right? So, if you've been listening since the beginning, we showed you a breakdown of buying a property for $100,000, putting 30 into it and flipping it for 200, right? Well, let's follow that same situation. You might be able to buy it for 130, right? It wouldn't be a good flip if you were, but maybe a rental, you buy it for 130, put 30 into it, you're into it at 160 of 40,000 of gross equity. Take out all the costs and things like that. Maybe you have $20,000 in equity, and then you can rent it out for $2,000 a month. You get a conventional lender in place, or a commercial lender in place, and maybe you can bring in $500 a month cash flow. And I know we're kind of spitting through these numbers quickly, but I think it's important to understand, based on you and your goals, how much equity you want built into these things, how much cash flow do you want? And again, we've been at the high side of a cycle for a long time now. So the last thing you want is, and actually this is something you could probably talk about too, depending on where they are. Like if you're on the growth phase, you're probably going to need high leverage because you want to, save your own cash, and you want to lever these things up as high as possible so you can buy more and more and more. Or if you're on kind of the more conservative path of like one a year, you might want to have more built-in equity, more cash flow at the same time, but also more built-in equity because you're kind of on the safe side. You're not on the growth side.
And I think what you're trying to say, and I think what people can take away from this, is that your underwriting model is a vision of what you want your investment life to be like, right? So any of us could take any investment model. I could take the one we just did here live on this show, and I can switch a few numbers and say, you know what? It's only going to cost us $3,000. And if I screw up, we'll be fine, right? Like I'm going to take that risk, and I talk myself into that deal versus saying, I'm Mr. Super Conservative. I'm going to pencil everything out. I'm going to over calculate everything, and I can't find a deal to save my life, right? Like, so I think it's very, and I know nowadays that there's actually I'm working on a quote unquote lead magnet of an underwriting model that I'd be comfortable sending to people to say, here you go, man, here's our underwriting model, use it, check it out. But any one of us can take any underwriting model and flip a number here or a number there and be like, this underwriting model said I'm going to make money, and you find out that you're losing money or you're hemorrhaging money. And here's why. You need to understand the numbers that are going into that spreadsheet, how they relate back to your capital, how they relate back to the overall deal, what it means to you to put out $5,000, $10,000, $100,000, whatever it is, or go get a loan for $5 million. You need to understand what that's going to do to you in your life. And I'm not Mr. like lifestyle this or blah, 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 that, but I will tell you that your underwriting model is pretty much a reflection of you, because I can be fast and loose, And a lot of my underwriting models, I'm like, yeah, you know what? Like I can do this, this, and this. And then I pass it to Dan, and Dan's way more cautious than me. And that's why we work well together, is that he's like, yo, dude, what about this, this, and this? And we come to a happy medium in the middle. And same as probably for you, Jason, when you're underwriting, making loans, that you can switch any metric you want and say you can talk yourself into any loan that you want to do by changing one number, right? So
yeah, I mean, in my opinion, with all of these, no matter what you invest in my opinion, I'd rather do less deals and make higher margins. Less deals, less risk, less potential work, but higher margins. So, and I know it's like, oh yeah, that makes sense. Everybody would want to do that, but we would win by marketing to try to get the most opportunities, right? Like I would rather spend my time and resources to try to find the best of the best deals and cherry pick the best of the best deals. So I believe there's too many investors out there that do too many deals for such small margins.
I know. I'm getting a text right here from one of our commenters, Brian Minatoli. He says, hey, you guys want to buy a car wash, right? And I would say, hell yeah, I'd buy a car wash. Let's put it in an underwriting model and understand how we're going to make money on the deal. And that's really what it comes down to, is having a model that says these deals work or these deals don't. And I think too many people either just go, yeah, it's going to work because Jason's doing it.
And they're fat. Yeah.
You know what I mean? Or people are like, well, it's not going to work because so-and-so said it's not going to work. Well, put it in a model, stress test it. Does it work or doesn't it work? And that's.
Yeah. And people look, and it's okay to learn kind of on the go, but like we talked about, we brought up that Excel spreadsheet earlier that we put in, like those are factual numbers. That's not an opinion. That's best case scenario. All right, real quick, let's talk about the basis of some apartment investing. And then let's talk about, and I'm happy to share some stuff related to private lending because I know a lot of people don't necessarily want to be like a private lender or hard money lender. No worries with that. But I do know a lot of people that have like 10 grand or 25 grand they want to invest with their, into a deal with somebody. It's like, hey, this guy has a deal. I don't have a deal. I'll just, lend them private money. Do we know if it's...
Yeah, and real quick, before we get too far from that, and maybe we should go into it, is that like, I need to understand how hard money lenders make their money and how you guys are underwriting deals so I can even go ask you for the right amount of money and understand my position so I can ultimately underwrite deals, right? But before we get to there, let's talk about apartment investing or syndication type deals or whatever. You're going to see a lot of crap thrown at you from the brokers, from the syndicators, from the sponsors, from whoever. And you're going to be like, yo, dude, this is overwhelming. But they said I'm going to make 25%. Well, you need to understand how they arrived at that 25%. There's a lot of junk fees. Is it waterfall? Is it, how are they creating value? Is there distributions to you during this whole thing? And a lot of, it's not just apartment investing. There's all kinds of syndicators out there. You can get into syndicates for horse racing. In the grand scheme of things, you need to understand how you're getting a return on your capital, how it's being distributed to you, and how often it's being distributed to. Because a lot of times, those things, they can jam you up and not make distributions to you till the very, very end. And when it comes to apartment investing, which is, a little bit different than how we do our single family models, you're buying, let's say you're the sponsor, you're buying in place income, right? Like in place revenue, and then you're tweaking a metric to increase your value of the property by increasing the rents, stabilizing, renovating units, whatever it is. And it can get very overwhelming because me and Jason have been walking through some deals. I've been showing them some stuff of some others. There's some big portfolios up for sale now, and it's just fun to look at them. And I was talking to Jason about it. It's overwhelming because the numbers have that many more zeros in it. But in the grand scheme of things, break it all the way back down to one apartment, right? Like, what did your numbers look like for one apartment, and then extrapolate it out over 200 units or 76 units or whatever it is, and you can derive your number. And there'll be some economy of scale based on the size of your units, but not as much as everyone expects. I lost my partner, so I'm just going to keep talking. But when it comes to apartment investing, that you make sure that don't get lost that you have 76 units or 200 units or whatever you have. Always take it back down to the granular level and say, what does one apartment look like? What is that one apartment going to cost me? What can I increase the rent by? What does that return look like? And then take it and times it by 76 or 200 or whatever your numbers are.
Yeah. And also, there's something to be said. If you have 200 units compared to one unit, you have all your eggs in one basket over here compared to that. So, And apartment buildings are complicated, and it's interesting. They're complicated, but the crazy part is what I've learned is you almost need less of your own money, and the capital's easier to get on a large, especially with bank money, easier to get on that than kind of a smaller scale, because it's as it grows, if it's a good deal, obviously. But we'll do a podcast soon about apartment buildings and apartment underwriting. It's an interesting topic, and I think a lot of people just don't fully get it, or they can't grasp it because it just seems like much bigger numbers. So they want to stick to the smaller stuff. But also at the same time, some of these apartment buildings that I've looked at with you, they're not all that great. They just aren't. Like, the numbers look bigger, so it's like, cool, if I can make $20,000 on a $150,000 flip, I can make $200,000 on this transaction. Well, that might not be the case.
Right, and that's what I was just about to say, is that it's just a metric of the dollar amount that's invested, right? Everyone's like, oh my God, there's like millions of dollars being transacted, so it's got to be a better deal. No, you've got that much more exposure, and you got that much more risk, and you have that much more potential of really, really going bankrupt versus just doing one house and killing it, making 1,000% return on one deal rather than risking it all for 5% on $10 million, right? Like, so again, you need to understand where your numbers are coming from, and it gets really hard if you want to be an investor into like a syndication type deal, that you got syndicators tossing numbers at you to try to make you feel warm and fuzzy, just like the brokers do. And you need to understand how these numbers were derived. And some syndicators will be like, get out of my hair. I don't even want to talk to you. And you probably should be like, well, it's probably not a good idea to invest there. If someone's willing to sit down and talk to you about it and be like, hey man, this is exactly how we got to our numbers, I'd be a lot more comfortable with that, because you are relinquishing some control in that situation, but you're still managing your money. Just like someone that relinquishes property management, they're still managing the manager. It's a similar type situation.
Yeah, no, I get it. Mike, we'll maybe Ian and I will prep that one for next week. That's going to take a little bit more prep to go into detail on it, but it'll be a good one. So we'll circle back on that. All right, so let's end this with, let's just say you have some private money that you want to lend out to a friend, do a joint venture with them or something, how to protect yourselves and how do you underwrite on that? I mean, you got to think about it like this. If you're lending on a deal, I mean, people have different mindsets on stuff, right? Some people are like, oh, well, this guy told me if I give him $25,000 as gap funding, I can, he'll give me whatever, $10,000 back. That's a super, that's a super high rate of return. I've got little risk just because it's only, $25,000, not a lot of money. I can still make a good amount of money on it. And, if everyone performs perfectly, you're right. That could be accurate, but there is a good amount of risk on that, right? Think about this. So let's say he or she gets a hard money loan for $130,000. The property's worth $200,000, and you give him $25,000. There's technically enough equity in that to potentially, cover and get you paid back if he performs. But if he doesn't perform, or they can't perform, or something goes bad, or construction goes overages, there's a good chance you're going to get wiped out and not be able to protect your interest and lose it all. I mean, it's very risky to be a second mortgage. A second mortgage or second lien holder. You just don't have a lot. In order to protect yourself, you really got to pay off the first. And hard money lenders, let's say it's a 13% interest rate return. That's $13,000 a year for every $100,000 that's lent out. Like, that adds up quickly. It builds into equity, and that's why if you're a real estate investor and you use hard money, which I'd encourage you, if you need it, if you can perform and execute. If you can get in and out of these projects quickly, a hard money loan or a high interest rate loan, it makes sense. But if it's going to take you a long time to do it, it's just going to eat up all your profits, and it doesn't work. So go ahead.
I was just going to say real quick, I think a lot of people lose the notion, and here I'll do the best pitch ever for you, even though that's not what this is about, is that like hard money is short-term money, and a lot of people lose sight of it. They get lost in their project. They get uncomfortable with what happened. They don't know how to get out of their problem, and it turns into a longer and longer situation. And that's the problem sometimes with hard money, right? But hard money is supposed to be a short-term solution to what you're doing. And if you can understand that and utilize that properly, and you back it into your underwriting model, which we did all the time with our rental properties, we'd say, okay, well, if we get the house done in 3 months, we can get it rented in another 3 months, and then get it refinanced in the next 3 months. our money's only out for 9 months. It's a carrying cost. It's a cost basis to the property. We'll get it back in tax deductions over the years. We're good to go. Or if we have to, there's other ways to handle your taxes. But long story short, we knew that we want to be in and out of our hard money loans. 6 to 9 months was our wheelhouse, and we understood that on day one. And to us, it was a cost of doing business. If it was 13%, whatever it was, it's a cost of doing business that you can ultimately leverage your capital to go a lot further.
Sure. But if you are going to lend to somebody, obviously you got to understand the risk about being a second mortgage. Now, obviously, if you're going to be a first mortgage, there's a reason why a hard money lender, a hard money lender who's been around and seen for a long time, or a private lender who's seen things happen and have gone through defaults. And unfortunately, it's very interesting that a lot of these institutional backed lenders have been very aggressive. And I know that's okay if you're trying to get high leverage to go with an institutional backed lender. But I can tell you for a fact that the reason hard money lenders lend at 65% based off the after repair value is if a deal goes bad and a deal really goes in default, all of that equity is stripped. It just is. It's stripped from potential back due interest, from attorney fees, foreclosure fees, judgment fees, property taxes that the company, the lender might have to step in, insurance, fines, violations. It eats up every darn penny of it, right? If a hard money lender does a loan and they go into default, and then all of a sudden the payoff's significantly higher because there's all those fees, they're not potentially recouping all of that stuff when it's all said and done. Deferred maintenance, like as well as I do, like let's say you have a property and you're halfway done renovating it and you run out of money and you can't do it, and you either lose it to the bank or whatever the case is, that property has to be completely re-renovated. That's just what's going to happen. There's deferred maintenance. Like this stuff is going to happen on that stuff. So there's risk on that. So if you're lending money to people, I know so many people that lend privately to their friends, and they should. I encourage it. You just have to do it the right way, right? You have to process it the right way. Like you got to put a proper promissory note in place. You got to put a deed of trust or a mortgage in place. You got to get title insurance to protect yourself. It doesn't matter if you're doing a joint venture, if you're doing a second mortgage, if you're doing a first mortgage, all of that stuff. But the important part is let's leave it like this. The important part is understanding your risk versus reward, and knowing that if you're doing a gap loan or a second mortgage for someone, that you have the ability to take over the project if they don't perform. It's that simple, because you don't have a lot of rights isn't the right word, but you don't have a lot of control if they stop making their payment or if they walk away from that thing, right? Like if they deed you over the property, you still have a mortgage on it, and that's okay. That could be Mike just fell. That could be a good solution. My hands are all everywhere, man, and
you're back into this little corner over there.
Jack my mic up.
But real quick, while you hit that, there is that like, as a borrower, I don't want to say, I'm not worried about the money that you as a hard money lender is making per se. I want to understand what your position is and how you make money, how you protect yourself, how you underwrite deals. Because think about it. If I go to a deal to Jason where it's like, it's worth $200,000, I want to borrow $180,000 all in, I know he's going to say no on day one, right? But if I go to Jason, I'm like, hey man, like I only want to borrow $100,000 total for acquisition and construction. I'll bring the rest of my funds. I know I could potentially be 100% covered because we're at 50% LTV or LTC, whatever the heck it is, however he underwrites it. But either way, that I know I'm bringing him a really juicy deal, that my deal is going to get funded. And I also have my own supporting numbers that I can back it up, that if it's like, oh, hey, I only want to lend you a 90 and here's why, I could say, well, did you see these comps? Because I underwrote this. What do you think about that? And he might say, yeah, dude, like, actually, you're right. I didn't realize that stuff was going on over there. I didn't put it, whatever it may be. Or he might say, yo, did you check out X, Y, and Z? And you might go, oh, crap. The lender's on top of it because he does so many more deals than me, that you're actually being protected. Because I tell people all the time is that you've underwritten your deal and then you go to a lender and they say, you're insane, we're not giving you a loan, or we're only going to give you a loan for this much. You need to bring $70,000 or $80,000 to the table on a $200,000 deal. You're probably in a turd of a deal, right? Like, so you're getting two levels of underwriting there. And if you're really lazy, you just bring the deal to Jay and say, hey, I want to do this. And He tells you no, and you're like, okay, well, I'm not doing this deal, right? But in the grand scheme of things, you have a second set of eyes from a different vantage point that you might want to step back and say, you know what, maybe there's something that goes on here. It doesn't seem right. I had a bad inkling on it, and now my lender's kind of giving me a backup on that. I'm getting out of this deal. And I think that's an advantage that you have by using lenders sometimes in these types of deals, whether it's hard money or a bank, whatever it may be. Or even like what Jason was saying, you go to your friend and ask for money and you know the deal's marginal and you're sweating bullets and you're shaking, not because it's your friend that you're asking money for, because you're nervous how this deal's going to go. You probably shouldn't be asking for them. And use common sense here. And I think it'll take you a long way.
Yeah, no, that wraps it up. How to underwrite different real estate investments. Feel like too many people are too emotional about projects. And I know we all, like we talked about, we'll end how we started. We talk about, I know you want to, be very proactive in marketing and emotional kind of on the front end in order to try to secure a good deal. And you should, but you got to have your underwriting cap on at the same time to make sure it's a good deal. You just have to. The best deal that you could potentially, or whatever that term is, the best deal you did is the one you never did.
Sure.
And it happens all the time. And, you don't want to kick yourself 6 months down the road and be like, oh, if you think it's going to be brain damage, if you think it's going to be an issue, it will. Every single deal has speed bumps in it, right? Yep. And speed bumps are okay. That's part of it. It's part of the game. But you can't go into a deal thinking, oh, I'm going to make $10,000 on this deal, because you're not going to. Typically, you always make less than you think. Construction costs are always higher. There's always issues. A pandemic comes in halfway through and you can't collect your rent, whatever the case is, right? Shit happens. It's part of it. So, my man, any last words before we wrap it up?
Yes, I know you got to run because you have another event to get to, but you left everybody with the best deal you do is the one that you don't buy. I'll leave you with, you make all your money on the purchase, right? Take the time, understand your numbers, and go out there and kill it.
Hi, guys. Hope you enjoyed this week's episode of the Real Estate Reserve Podcast. And check you all next week. Make sure to check out reimadness.com. Ian, do you mind putting that in the comments real quick? reimadness.com. We got a really good group of speakers starting January 25th. And don't worry, we got a lot of reminders coming out, so you'll see it before then.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too.